Hello, everybody, and welcome to the latest edition of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners redomesticate out of volatile legal and tax jurisdictions like California to predictable pro entrepreneurship, pro growth states like Florida and Texas. Today, I'm reviewing a recent report by Mary Whitsville Roloffs, writing for Forbes, entitled Google Billionaire Sergey Brin Compares California Wealth Tax to Soviet Union Socialism. His terminology and characterizations, not mine. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business tax and commercial law throughout the growing states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's in accounting and a master's in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, on to business. Forbes reported on April 28th that Google co-founder Sergey Brin spent $57 million fighting a proposed one-time 5% wealth tax on high net worth Californians. Brin, whose family actually fled the Soviet Union in 1979, stated that he does not want California to end up in the same place. That is not a casual offhand remark from a passive observer. That is a man with a net worth of over $260 billion writing a $57 million check to oppose a tax proposal he views as an existential threat to the state's economic future. And he is not alone. The Forbes article documents a parade of billionaires fleeing California in direct response to this proposal, which I might add is expected to advance to the ballot later this year. Larry Page, co-founder of Google, net worth $281 billion, moved or terminated more than 45 California limited liability companies last year and purchased a homestead in Miami. Brin terminated or moved 15 California LLCs out of the state and has acquired property in Florida and Nevada. Mark Zuckerberg, net worth $231 billion, is also leaving. Peter Thiel, net worth $29 billion, was among the first to move both his company and his residence out of California and later donated $3 million to fight the proposed tax. Don Henke, the car loan magnate worth $8.2 billion, left California for Las Vegas. The former CEO of Uber confirmed his move to Texas, as the DoorDash co-founder also announced his plan to leave. Oracle founder Larry Ellison, net worth $217 billion, lives in a homestead in Palm Beach County, Florida, purchased in 2022. The union backing the proposed wealth tax reported collecting nearly 1.6 million signatures, which is nearly double the 875,000 signatures required to place the measure on the November California ballot. Those signatures have been submitted for verification. If the measure qualifies and passes, and I believe it will, it would impose a one-time 5% levy on net wealth for certain high net worth individuals and business owners, with approximately 90% of the revenue purportedly directed to public health services, although that is somewhat nebulously defined. Supporters frame it as a response to federal healthcare funding cuts. Opponents, including California Governor Gavin Newsom, argue that driving billionaires out of the state will inflict more damage on California's economy and budget than the tax could ever generate in revenue. That is a view which I share. The governor is correct on the math, though perhaps not for the reasons he articulates. The billionaires are not just moving their residences, they are also moving their companies. As I mentioned, Page moved or axed more than 45. Brin moved or terminated 15. These are not symbolic gestures. Each of these companies represents contracts, employees, vendors, banking relationships, and taxable economic activity that California will no longer capture. When a high net worth individual moves a residence, the state loses personal income tax revenue in addition to business revenue. When a billionaire moves 45 LLCs, the state loses the entire economic ecosystem those entities created. The destinations are telling. Florida, according to the article, is where most of them are headed. Thiel, Page, Brin, and Zuckerberg have all purchased homesteads in Florida. Knight Frank's annual wealth report noted that luxury residential prices in Miami have risen 67% in the last 5 years, and Palm Beach luxury prices, which is just north of Miami, if you don't know, have risen 90.5% over that same time period. That price appreciation is a direct consequence of capital and human migration from states like California into the Sunshine State, which is a jurisdiction that imposes no state income tax on individuals. Now consider the position of a business owner who is not a billionaire, but who does operate an LLC or corporation presently domiciled in California. The proposed wealth tax currently targets individuals with assets exceeding $1.1 billion, so it may not apply to you today. But the signal and the precedent it sends is unmistakable. California already imposes a top marginal individual income tax rate of 13.3% on income above $1 million. It's actually higher when you factor in the payroll tax. California also imposes an $800 minimum annual franchise tax on every LLC registered in the state, regardless of revenue or activity. It layers on regulatory costs, litigation exposure, and compliance burdens that compound year after year. The wealth tax proposal is the next iteration of a policy trajectory that has been moving in one direction for over a decade. If the wealthiest people on earth are spending tens of millions of dollars to fight that proposal, whilst simultaneously relocating their domicile and companies to other states, the signal for a business owner earning $200,000 or $500,000 or even a couple of $1 million through a California entity is absolutely pellucid. The mechanism for moving your existing company out of California is redomestication. And to dispel a very widely held misconception, California does permit redomestication of LLCs and corporations, contrary to what you might have heard elsewhere. I know because we have completed many of them successfully, all of them successfully, in fact, a true 100% success rate. California allows redomestication, and redomestication is the legal process of transferring the home state of an existing LLC, corporation, or partnership from one state to another. The company retains its existing federal employer identification number, contracts, bank accounts, and credit history. No new entity is formed. No assets are transferred between companies. No federal income tax is triggered when the transaction is executed in strict conformity with the Federal Internal Revenue Code and applicable Treasury regulations, as well as the statutory requirements of California and the destination state. The company that exists after the redomestication is the same legal entity that existed before. The so-called alternatives are really not alternatives at all. Foreign entity registration, also referred to as foreign qualification, keeps the company domiciled in California and merely registers it to conduct business in the new state. It is not a relocation mechanism, and it means continued compliance with obligations and tax exposure in California. That is not leaving, it is paying rent, so to speak, in 2 or more states. A traditional merger, on the other hand, requires the formation of a new entity with a new federal employer identification number in many cases. The transfer of assets, the renegotiation of contracts, and can trigger a taxable event if handled incorrectly. Legal fees for a merger, I should say for a simple merger, can reach $10,000 or more, let alone a complex merger. Dissolution, finally, dissolution, also referred to as termination, although those are actually two distinct legal concepts, but we'll stick with the term dissolution for today, terminates the company. It is the death penalty. It eliminates the liability protection and therefore exposes the personal assets of the owners to claims both known and unknown, jointly and severally, in an unlimited amount. For a business owner who intends to continue operating, dissolution is the financial equivalent of setting your house on fire and then trying to move the furniture. If dissolution is coming up in your conversations with your CPA or attorney, it's time to seek a second opinion. Dissolution should only enter the conversation if the business is truly shutting down. Now, Larry Page moved 45 LLCs. Sergey Brin moved 15. These are not stupid people. They understood that personal relocation without business redomestication is a half measure at best. The company must follow the owner or the tax exposure remains. Don't rely on my word. Ask your CPA. Hopefully he or she is at least aware of this process. If not, it might be time to find a new tax preparer. But that's another story for another day. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this process and to schedule time for you and I to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature, and it is not legal advice because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to the opportunity to speak with and maybe even work with you very soon.